Okay, I think we might make a start. So good afternoon, everyone, and thanks for joining me for webinar 2 of the Building Farm Business Resilience website webinar series. This series is brought to you by Agriculture Victoria, as you can probably tell by looking at the intro slide. In today's webinar, Matt McCarthy will again be hosting, and he will be exploring the financial resilience of farm businesses. Matt will be joined by Jane Foster in the second half of this webinar. Jane's also from ORM and Bendigo, and she is a managing consultant. She will also be discussing financial resilience of farm businesses. Just before we get Matt started, just some housekeeping. You might notice down the right-hand side of your screen, there's an opportunity for you to ask questions using the chat box. Throughout the webinar, there'll also be some live polling. Where Matt will ask a question just to get some feedback from participants and help to inform any more content that he'll cover today. At the end of the webinar, you'll receive an email, an automated email from ORM, and it'll just, if you could reply to that with any feedback, that would be much appreciated. And yeah, this recording will be, this webinar will be recorded so that you can replay it down the track. Probably, I'll mention this again at the end of the webinar, but if you have any other feedback that you want to give that you don't feel like putting in an email, you feel free to call or SMS me on that number shown. You can leave a voicemail if I'm not available or busy on the phone, or send me a text. I had some good feedback with that last week. My email address is also there. Okay, I think that's all from the housekeeping, so I'll hand you over to Matt to get started. Thanks, Matt.
Being affected by diplomatic stoushes between countries. Banks are reviewing their processes around lending and finance. And so there's no better time really to discuss farm business resilience, and particularly farm financial resilience. So welcome today to our second webinar in this series on building farm business resilience. We'll just recap quickly. Just a couple of things we mentioned last time. Farm business resilience, it's basically the capacity of your business to adapt to and recover from a major disruption. And last time we talked about what those disruptions would be or could be. And again, just recapping on what we discussed last time, the 3 pillars of the business. So last webinar, we focused in on the people aspect of the business and around management and decisions. Today, we're going to focus on the second pillar, which is the farm financials. And the third pillar is the resources pillar, which is pretty much a production system and everything related to production. So today we're going to focus in on financials, and that is effectively issues or factors such as profit, cash flow, debt management, and financial buffers. So in this webinar today, we will be discussing profit, income and costs, assets and liabilities, financial buffers, and how we access financial buffers, particularly when we hit a financial shock or a financial disruption to the business. As a starting point, I wanted to just put in context the business life cycle. So all farm businesses go through this life cycle. They start off as an emerging and growing business when equity is relatively low. And over time, they build equity, and you'll notice that curve over that time, the equity grows, and then it starts to flatten out, and the business becomes consolidated, and then what we call a standing still phase. And then inevitably the business hits stage 5, which is a review. And at that point, the business will transition to the next generation, or it may could be sold off and the owners retire, or it could be a combination of both. So the business could be leased, the owners could retire and lease the business, but something happens at that point. And that's generally about 25 years, that life cycle, as a general rule, about 25 years or a generation. So in stage 1 and 2, the focus is on building scale and equity, and very much around cost control, maximising profit to enable equity to be grown. And then in consolidating and standing still, the business works on building financial buffers, off-farm investments, and cash surpluses, etc., off-farm, as well as equity and debt reduction. So that's the common life cycle of any farm business. So let's get started and get people involved with a poll now. We're going to ask you to think about where your business is positioned on that life cycle. So you'll have a poll come up now, and so we're just asking whether you believe your business is in the emerging and growing, where you're doing the hard yards in getting the business established. It could be consolidating, where you're focusing in on debt reduction and building off-farm investments, etc. And standing still is a similar sort of phase. And then, or are you in a review phase where the business is at the stage where it's going to have a major restructure or reinventing? And so you can, if you can all have a go at positioning where you reckon your business is at. We'll give you a minute to do that. So we'll probably give you enough time now. So we'll close that poll in 5, 4, 3, 2, 1. Thanks for taking part there. So where have we got our audience positioned? So it looks like we've got at least, yes, we've got a fair proportion in the emerging and growing. As I said, doing the hard yards. That's around 30% or 40% in the emerging and growing. Consolidating, we've got a group there. We don't have any standing still. It's not a really good term, standing still. That's it could be retermed. I think we could come up with a better term for standing still, but it just means it's a point where the business is pretty well established and is sitting pretty. And we have a group there. 13% of the audience are in the review phase, which is interesting. So we've got groups at either end of the scale, and so financial resilience is still important for all those stages, because when a business gets to the review stage, it nearly always has to have a split up of assets and of financial assets. So the stronger the business is at that stage, the better. And in those emerging and growing stages, as we've mentioned, just purely focusing on managing and attaining profits, building equity, growing scale, getting established is the hard work. So thanks for taking part in that. That gives us a good picture on who we've got on line today. So I'm going to introduce our guest today, which is Jane Foster. Jane's an agribusiness consultant with ORM, and I would like to welcome Jane. Jane now. You there, Jane? Yes.
Really great to be joining you today to discuss building farm financial resilience. That's great.
That's good, Jane. So, Jane, you've been around the farm financial space for some time now.
Yes, well, I have a long history in banking and finance, going back sort of 15 plus years experience in that industry. So yeah, I was working very closely with businesses in regards to the financial aspects of management. And I'm now with ORM, Senior Agribusiness Consultant. So again, still working in very closely on the financial aspects, but probably just from slightly different side of the fence. And yeah, very enjoyable. It's always great to be able to work with people to, manage their financial aspects. And somewhat give them that reassurance so that they can focus too on, the productive parts of the business that they need to sort of get right every day.
Yeah, that's good, Jane. Welcome along, and we look forward to having you involved. What we're going to do is we're going to work through a case study a little bit just in a minute, and get some input from you on that case study. So again, welcome. So we'll catch up with you just in a moment, but just to go back to a couple of points I wanted to make. So financial resilience, what is it? Effectively, it's being able to generate profit, as I've mentioned earlier, sufficient profit to provide for the owner after meeting all costs. And simply the other point to financial resilience is building financial resources that sustain the business through a period when the profits are not achieved. And so this is point B is often is well known in agriculture, that there are circumstances that arrive, seasonal circumstances, etc., when the business is not profitable, and the business needs to be able to sustain itself through those periods. So that's a measure of financial resilience. So we are going to look at a farm case study today and get down to look at some actual figures around what farm financial resilience is, how we measure it, and what we can actually do to manage it, and when the conditions are such that we need to draw on the business's resilience. So this first slide is basically gives a bit of a helicopter view of this farm business. It's a cropping livestock property, and this gives a 5-year average income breakup. So effectively, if you look at the circle or the pie, that's the income generated each year on a 5-year average basis for this property, and it's been allocated to where the income is spent effectively into some key groups, key cost areas. So you can see there that the overheads consume 8% of the income. Finance costs consume 12%. Labour, which includes an allowance for family members or drawings for family members who work in the business, takes up 14% of income. Machinery, which is where a lot of focus is put, and machinery is critical to any cropping livestock property, consumes 26% of income. And then farm inputs driving production, again, consume 30% of the farm's income on an annual basis. So as you can see, the surplus, cash surplus remaining, is approximately 10% of the farm's income over that time is generated into surpluses. And that's important because those surpluses go towards building financial buffers. And the way that the financial buffers are built are through reducing debt, off-farm cash reserves or farm management deposits, those types of facilities, and off-farm investments. There's some of the key ways to build financial buffers for times when the farm needs to draw on them. So I'll make the point that this is a very high-level analysis. Many farms would look like this and have this similar structure of costs, but the details of those costs are going to be different. However, underlying this type of analysis, you have gross margin analysis, you have enterprise analysis, cost of production analysis that sit under this level. So this is a very high-level picture of the income, the farm's income and costs. So Jane, this would be a familiar picture for you, this type of breakup of costs and income?
Yes, Matt, it looks good in terms of a graphic representation of what happens in terms of the financial resources of farm business over the course of, say, an annual cycle. And I guess some of the points to note here is that, of course, we're trying to make the size of this pie as large as possible. And really, the surplus, which you see there is the yellow portion of that pie, which we might also refer to as profit. That is really the component that's going to work towards building financial resilience over the sort of medium to long term. So it is important, as you'd see, there's many components of this pie, and we have to manage all of those appropriately within the business context. It's also, there are often competing priorities. There are often events that happen that are unforeseen. And the overall picture is that we try and achieve a reasonable outcome at the end of the year that, as you've indicated in the pie chart there, we're looking at a surplus of roughly around 10% of total income that comes through, which is the bit that's left over after we've met all of the operating costs of the business throughout that annual cycle. So I just make that point that really the surplus is the key to building farm financial resilience. And without that, it becomes quite challenging to sort of put, I guess, away money for a rainy day, or in the opposite event, droughts and those sorts of adverse impacts. The other thing to note, I guess, one point I sort of make on this is that sometimes we talk profit, but profit and cash flow in themselves can be slightly different, and particularly as you saw through your business life cycle, growing businesses often have some fairly significant cash flow constraints because they are growing. And whilst they may be profitable, because each year they're trying to sort of achieve more and become larger, they consume quite vast amounts of cash in that cycle of doing it. So that is a point to note, that as businesses go through the different sort of stages of the life cycle that you pointed out, and their equity is growing, they also have to be sort of careful to manage their cash flow and available resources to meet expenses.
Yeah, no, that's a good point, Jane. I was going to go back to that graph and mention that I suppose the emerging and growing businesses are, for those reasons you mentioned, are most vulnerable to a major disruption. So whether that be a seasonal, a very poor season or other shock. So compared, when those businesses are in that emerging stage, they're actually the most vulnerable to a disruption.
Yeah, that's completely accurate, Matt, and that is due to the fact that there's often not significant levels of equity comprised within the business, partly because just in terms of the duration of time, they haven't had the available time to build those resources. And also, as I mentioned, they are growing, and that does utilise a lot of cash. So they often don't have sort of available cash that might cover them through a period of time when income has been, down on what it might be on average. And I guess there's two ways of looking at that we can talk about. We can talk about historical averages, so we can look backwards at how the business has performed over the sort of prior years, and often we can draw that information out through financial statements, which are provided to most businesses by their accountant. So that provides a good mechanism of perhaps reviewing costs as a percentage of income and just doing some calculations historically. And then secondly, we look forward in terms of budgets and cash flows. And so they can be really important planning tools, particularly for those businesses in the emerging and growing phases of the life cycle, to ensure that they at least have a picture of what their future looks like. And then if a disruption does emerge, they are in possibly a better position to adapt quickly and take that into account. So that is, there are mechanisms to measure how you've performed in the past and then form a view of how that looks in the future. And it's always, I guess, we suggest a good idea to have a bit of a running budget, because as a very experienced banker once told me, there's only two ways to increase profit, and that's either you increase your income or you decrease your costs. Now, within a farming business, often our potential income is we can quite ably determine what that will be, because it is somewhat constrained by our physical resources that we have available. So it is important that we take a view of what our average income might look like going forward, and then that gives us some guidance as to how we can manage our costs going forward, and particularly because the aim of the game is to try and ensure that we can generate those surpluses that are what will help us build financial resilience.
Yeah, and so as a way of summarising there, I meant to mention earlier, this farm on the 5-year average its income has been around $1 million. So its average surplus has been about 100,000. So just to put that into perspective. So we might move on, Jane. We've covered the profit generation there. To move on to talk about assets and liabilities. So I've put up a slide there which is a summary of this business's assets and liabilities table, and so we can see there that the land is valued, the land is valued at $4.5 million. Machinery and livestock are grouped together and are valued at just on about 1.2 million in total. And then we have some liquid assets, which is pretty much stored grain, some cash and FMDs, and off-farm investments of around 350,000, which takes our total assets to just over $6 million. And then we've put in there the liabilities or debts that are against those assets, which is working capital, which is secured by land of 200,000 with a limit of 500,000. And then we have land loans or bank loans valued at 1.3 million. So, and then some of the machinery is financed at 150,000. So the total liabilities are 1.7 million, bringing the equity to 4.4 million, and an equity of about 72%. So that's I suppose a typical summary of an assets and liabilities table, and yeah, this one's relating to this particular business.
Sure. And so, yeah, I'd probably make the point there, Matt, that obviously the composition of how the assets in the business are financed is really an important aspect in terms of the risk profile of the business. So we can see in this instance, there's, as you said, the total assets there of around $6 million, and we've got total liabilities of, say, 1.7. And so literally the 6 less the 1.7 brings us back to 4.3, or in percentage terms, we say this business has 72% equity, which is considered to be a very strong position. So that's very positive in that regard. But on top of that, I guess I would say one way of looking at the equity or understanding the equity piece of the equation is that equity is really the business owner's portion of the asset. So whilst the total is 6 million, there is 1.7 million in total there that is owed to a third party. So in effect, that is the asset of the third party that is invested within your business and helping you generate returns. So there's quite a significant difference between the thought process between debt and equity. And equity is what can build resilience within a business. Because at the end of the day, if the business experiences a downturn and the financial outcomes might be a lot less than on average, the business may experience losses, those the people who own that equity in effect have to absorb whatever the performance of the business was in that year. By comparison, the owners of the debt, or the people who provided you with debt, they're not so much interested in how the business performed. They provide the debt on a term, which is interest plus sometimes amortization, and irrespective of how the business performs, they will want to see their repayment met. And so that's why higher levels of equity in business do create resilience, because the equity holders or the equity owners tend to be a lot more flexible, and they also have to absorb the losses of the business in conjunction with the profits. So they are sharing in that performance of the business, whereas the providers of debt don't share in any level of performance. They have set terms on which they provide that money to the business.
Right. Yes. So the bank's partnership in the whole show in this case is its share is around $1.7 million. So thanks, Jane. Have we got any questions, Mark, coming in?
Thanks, Matt. Actually, no content-related questions, but we are having a few technical issues with people unable to hear you. Yeah, I think we've found out they might be browser-related, although not definitely.
Yep.
Can people just add some add some messages to the chat box down the bottom right if they're also having issues? There's two people so far who are unable to hear Jane. Okay. They can hear Matt, but they can't hear Jane, and then
Okay.
But no actual technical content-related questions as yet, Matt. So I reckon we'll just keep rolling.
Okay. Yeah. No. Sorry. There's a technical issue there. Nathan's checked from our end. Everything looks to be working well. So it could well be on the user end, unfortunately. So we'll push on anyway, and hopefully they can catch up.
Yeah, I'd think out maybe Google Chrome. That's it. Looks like some people are using Chrome as their browser. That might be the way to go.
Yeah, that's right. That's one that often comes up. So so we'll push on and talking on the assets and liabilities, Jane. So the assets and liabilities table, as I've just mentioned, is sometimes called a statement of position, and also balance sheet is a term that's used as well. And we hear these terms thrown around. I wondered if you could just clarify: are they the same thing or not?
Yeah, it's a really good point to make, Matt, because I do hear these terms sometimes used interchangeably, and people will talk about their asset liability table, statement of position, balance sheet, and they do in essence look at a similar theme in terms of listing of assets and liabilities. But I just here make the point that there are some actually very distinct differences between technically a balance sheet and a statement of position. So, for instance, in the banking sector where I worked, we would generally look at both documents. Now, the balance sheet actually comes through the financial statements that your accountant would normally provide annually. And the balance sheet is essentially a snapshot of the assets and liabilities of the business on a single day of the year. And generally speaking, for most people, that date is 30th of June. Yep. And so we look at on that date, what was the value of the assets, what was the value of the liability. Now, the issue with balance sheets particularly is that there are some quite regulated accounting rules around how a balance sheet is prepared. But generally, assets come in at cost of acquisition. For instance, land is at cost of acquisition and it's not a depreciating asset. Machinery and equipment will come in at cost of purchase, and then there'd be generally some specific rules around how that's depreciated. And we've seen things like the implementation of instant asset write-off now, which is essentially saying you buy it, pre-30th of June at the moment, and you can write it off straight away. So for the terms of your balance sheet, that asset would essentially be depreciated to a zero value as of next year. Mm. Whereas a statement of position is really a look at the assets and liabilities on any given day of the year. You can write one up on the 30th of March, but it takes into account the assets at what we would consider fair market value. And in saying that, it's saying that if we had to reasonably sell these assets within a shorter time frame, say, next 3 months, what would the market actually be prepared to pay us for those assets? And so that can be particularly important in farming businesses because, as we know, land can form such a large component of the asset base here. And we do see some quite strong, or have seen in the last 24 months, some quite strong gains in the value of land. So the statement of position can take into account what the asset value would be now as compared to what it was when we might have acquired the land, which may have, for instance, been 5 years previous. And so a statement of position does give probably a much clearer and better snapshot of the true financial position of the business as it stands, currently right now. And that's why in banking, whilst we did use balance sheets, we were also very particularly more interested probably in statements of position, because they do give that really good, clear picture as to the available resources that a business would have to draw on if required.
Yeah, right. Thanks for clarifying that, Jane. That's something that I think can cause confusion, just the difference between those particular documents and numbers and the numbers in them. So thank you for that. We'll move on to just coming back to our case study, which we've looked at the assets and liability summary, and what I've done here is presented it in a slightly different way. So it's presented as a graphic. So you can see there that the three key areas of assets in the business are, of course, the largest one is land, and the next is machinery and livestock, and then the third category is the liquid assets, which are valued there and are in purple. So if that's our asset base, we then overlay the bank facilities that we talked about earlier, the lending facilities that are in place, and that's shown by the pink, and is secured by the land. So it's taken up some of that green space, which is freehold land, or the land that's owned, and so that's the current bank facilities. So if we assume that the land buffer, the bank will lend to 60% of the value of the land, 60% of 4.5 million, it suggests that there is capacity to redraw on this bank debt in the situation of a major disruption or a financial shock. It's suggesting that there's a buffer there of 850,000, which could be drawn down on potentially if needed. So Jane, this looks quite reasonable to have a buffer there, and something that's accessible. What would be required if we wanted to go to the bank and access this buffer, and is that amount of buffer actually accessible?
Yeah, some very interesting questions there, Matt, and probably a few points that I can make in regards to posing those questions. So in this example, for instance, we've taken up the assumption that we're assuming we're going to a bank to assist with some funding requirements, and that they would be within their ability to lend us up to 60% of the value of the land. Now, I probably have to put a little proviso on that number, because we are seeing that can fluctuate depending on industry conditions and just in terms of the actual banks and their view and of their risks and risk profiles of business. So working off that 60%, that's achievable. But you will see that potentially would vary also in terms of geographic location. So it's not to say that that's consistent probably right throughout Victoria, and that's something that particularly should take into account areas where income volatility might be more significant. The banks might like to see more owners' equity in there, and they might not be sort of going out to that 60% level. They might come back to sort of closer to 50. So that's a point that people should really take account of as well, depending on their personal situation. And second to that, I guess the land value that we utilise is also quite important here, because sometimes our view of fair market value will be slightly different to what the bank might achieve through a valuation process. So there are those two factors. But otherwise, yeah, it's a fair estimate, and it's probably an exercise that is relied upon to get people through those poorer income years, and that's often seen through overdraft increases. To approach the bank, it is important to have good financial records. And one thing a comment I would make is that in the last, say, 3 to 4 years, we've seen quite a significant shift in the bank's view towards lending applications. So they are asking people for quite a lot more information than may have been the case historically. So you're likely to have to provide them with your historical profit and loss. You're also likely to have to provide them with a budget forecast or a cash flow. They may use either one of those terms. They generally want to know if your ATO obligations are up to date, so that's your GST and any tax that's due and payable. And they really are taking a much more sort of holistic view of the business to understand what is the business trying to achieve and what's caused this need, I guess, to draw on some of the equity within the business. And I would say that the track record of financial performance is something that they are definitely taking much higher regard to in balance with where the equity position of the whole business is. So if the historical financials reflect that there hasn't been, hasn't been a profitable business, say, they will ask quite a lot of questions as to, well, how that's going to be addressed.
Thanks, Jane. So from what I took from you there, that buffer that we were looking at, that I've suggested there might be, 850,000 there. That's probably the maximum that we would be able to, in theory, be able to access, because what you've said is that possibly the bank may have a more conservative land value, so it may not be valued at 4.5 million, so it could be 60% of less, and also they may also not be. They may come back on the 60% of being available. So we've probably got that at the max in a way from what you're saying, and also in terms of approaching them to extend finance, they are particularly or becoming more interested in the historical performance of the business as a measure in terms of how much they would allow the business to access further debt, further lending.
Yes, well, it's always been a concept, I guess, in banking that we do have to have a view of how will the client or business actually repay the debt. However, it's probably, if I went back 5 years, and it really, I think Royal Commission, we could say, was the tipping point here, has deemed that they have to take a much stronger view of how can the client actually repay this debt from the income of the business. And so where the historical performance, and it refers back to really the I guess, pie chart you showed us early in the presentation, Matt, if that piece of surplus is considerably less than, say, 10%, if it's getting closer towards 1 to 2%, then that makes it actually quite challenging for a business to demonstrate that it could repay debt over, say, a 15-year term. And that's a bit of the metric that the banks are using now to analyse the credit applications and the credit risk. So you do have to, and often we've prepared budgets and things, and you have to be able to validate the forecast budgets against the historical performance. So it's not quite as simple as, say, you give them a glowing budget and they're satisfied. They're looking a lot deeper than that now, and they will look back at historical performance and then want to understand how that compares to what we've projected in the future. So it's definitely more focus on that income and expenses side of the ledger than there might have been if we talk about 5 to 10 years ago.
Okay, thanks, Jane. So we've run into this is where we're looking at our worst case scenario. The business has run into some major issues, being a drought or a very poor season, and so we're looking for these buffers that we've built up. We're looking to these buffers to see us through this period of difficulty. So the next buffer that I had identified potentially was in the financing of machinery and livestock. So we've got we've got machinery and livestock finance at 150,000, and potentially we may be able to borrow or finance up to 50% of the value of machinery livestock. So I figured that there may be another 460,000 that we could potentially access from that asset area. So is this a reasonable assumption to make, that we could, and how could we practically access that buffer, that theoretical buffer?
This is a really interesting question to pose, Matt, because I guess in all my time in banking, we didn't really deal in this space very much at all to assist businesses that were going through some type of disruption. It generally did rely more predominantly on real estate assets. But in making some general comments, so if there is machinery that is owned outright, and probably one of the key components there is the age of the equipment will have a huge bearing on whether you can actually go out to the finance providers and ask them to refinance. So that would mean that, say, if the tractor's 2 years old and it might be fair market value is 200,000, then they'd extend you a loan of 200,000 on the basis that you might pay that back over 5 years. So it gives you the cash injection up front, but of course you do have to be able to meet those ongoing commitments. There's limitations. Generally, finance providers don't like older equipment. They find it a bit challenging. There's also, if you do go down that path, often you will be going to maybe not the main tier banks. You might have to go to alternate finance providers, and you just have to be aware of any costs associated. And that's not just interest rate. That might also include things like establishment fees, because sometimes they can vary greatly. So machinery can be a tricky one to try and unlock the equity. And then again, with livestock, there are specific businesses that are engaged in providing finance against livestock. And probably the main comment I would make here is that in terms of the cost of that, we're probably seeing roughly around, in a livestock finance, you might be asked to pay a 10 to 12% per annum interest rate, whereas if you compare that back to using real estate as security, you can be in some instances loans around 3%. So you're paying quite a premium cost to fund or to get access to cash through using livestock. And that's not uncommon. There always has been that disparity. And so you just would really have to take a strong account and factor in those costs of going down that path. So it is possible, I would say that, but it is slightly more challenging, and you need to find a finance provider that probably sits within that livestock space, or one that's happy to deal with used second-hand plant and equipment.
Mm-hmm. Yeah. So from what you've said there, that would be one that we would go to as a last point of call, potentially. But there may be some flex or some ability to manoeuvre in that space. But if we move on to the liquid assets, this is an easier asset group to draw on, because 100% of this asset is available and is for our discretion to be used. The cash reserves, farm management deposits, off-farm investments and stored grain. So in this case, we can draw down on that pretty much as we please. So what do we have to think about if we were looking to draw down on these assets?
Yeah, so these assets really form what we call or term the working capital of the business. So it's what's available that could be utilised at very short reference or very short call to pay for the expenses of the business. So that is obviously cash in the bank. It's readily accessible. The issue maybe with holding large, say, grain inventory, for instance, is that you are a little bit obviously exposed to markets. So at the point where you may need to sell grain to meet some working capital or cash flow requirements, you know, the price may have moved slightly not in your favour. So they're things to consider. And the other part of the equation is you can sit significant amounts of cash in the bank, for instance, but currently you'll be earning very little interest on that money. And so there is that quandary of, is that the best thing to do, or should I put that cash into something else or invest it somewhere else? So it is a quite a fine balancing act in terms of how much we have in reserve, I guess, as liquid assets. Partly because holding large amounts of inventory exposes us to some level of market risk, and then also cash doesn't yield us much return. So that's probably the two things to really consider in those asset classes. And just going back one step to the machinery and livestock, I probably would say it's those categories of finance might be something that you see used a little bit more in those emerging and growing businesses. And then once they sort of move into that mature phase, there's less call on it. So it is utilised, and it's probably where it's utilised in terms of the business life cycle.
Very good. Thank you, Jane. I don't see that I don't think we've got questions coming in, have we? Or do we have one?
We've got one question there, Matt.
Sure. Far away. I can't see it.
Matthew Hawken would just like to know how are the banks valuing water assets as high reliability and low reliability at the moment? So, Jane, I don't know if you can talk to that.
Yeah, look, it's an excellent question, and I know when I was actually within the bank, that was the time period in which water titles transitioned and became their own statutory titles. So the banks are taking, they should take a similar view in terms of how they value it. Should be at market, but I couldn't give too much specific commentary because given the nature of water markets, they may be applying different methodologies, and I'm not sure whether they tend to possibly engage some specialists in valuing those assets, because of course they'd be a little bit wary potentially that fluctuations in the market value could leave them somewhat exposed. And then the other issue would be they might apply the level against the market value that they'd be happy to extend credit to might be significantly more conservative. And I do know that they tend to look at, obviously, high reliability is to them the better asset class. So I can't give specifics on what their methodology is, but I would suspect that they would be using valuers in that space, particularly at the present time.
All right, great. Thanks for that, Jane. Hopefully that answers your question, Matt.
Thanks.
Feel free to add any other questions down the bottom there in that chat box if you like. I'm just aware that there's not too much time left. So if you do have any questions you'd like Jane to answer now, please get in quickly. Back to you, Matt. Thank you.
Thanks, Mark, and thanks to Matt for that question. So we've covered off on we've got an idea here of what our buffers look like in this business. So the question is, are the buffers sufficient? So as we talked earlier, how do we assess the financial resilience? Like, are these financial buffers we have in this business sufficient to say that the business is resilient? And how do we actually do that? Well, what we're suggesting to do is that we look at the worst financial loss that the business has made in the last 5 to 8 years, and then we use that as a bit of a test to compare that with the buffers that we have in place, or the coverage we have to cover a loss if it occurs, if and when it occurs. So with this particular business over the last 5 years, this graph shows the income and costs basically for that business. The costs being grey and the income blue, and the green line is the profit line for this particular business. So as you can see, it's been an up and down ride, as is often the case. And the worst loss that the business has made was there in year 2, which was 300,000. So we used that 300,000 as I said, as a test. So the worst loss, as we said, was 300,000. In our graph we showed earlier, the land debt that we could redraw on and the liquid assets we had without looking at machinery and livestock finance were approximately, 3 to 4 times the worst loss, depending on that discussion we had with Jane, depending how much we actually got access to in the land debt redraw. It's around 3.5 to 4 times the worst loss the business has made in the last 5 years. So that's a relatively resilient situation. The suggestion is that we need to have about double our worst loss situated as financial buffers that we can draw on in the case of a major disruption. So Jane, do you think that's a reasonable, and what are your thoughts on that in terms of a rule of thumb around, resilience?
Yeah, look, Matt, that looks, really reasonable to consider that we have access to that level of buffer, because I guess that's making an assumption there also that we would sort of see, if we said that each loss represented one annual cycle, that we have enough buffer there potentially for 4 in a row of the worst years that we'd seen. And, I guess we have to talk in terms of the chances that would happen, and certainly that to say that you could sustain 4 fairly adverse years, I would suggest is a pretty strong position to be in. So I wouldn't be too concerned in that regard. But of course, that does assume that we can access those equity reserves through land at the levels that we designated in this case study, through livestock and through machinery. So if we start to take some of those out of the equation, potentially that obviously will have an impact on that outcome.
Yeah, and I suppose when it comes to talking on how much reserves we have in place, it's also very much a personal choice and a personal attitude to risk and to how much buffer we have between us and a worst case scenario. So so some things to think about at this stage would be for the audience is that if you can do a rough calculation as to what your buffers are relative to the worst financial loss you've had in the last 5 to 8 years, and to think about what are you comfortable with in this regard? What level of buffer are you comfortable with personally? Because it comes down to personal preference. So we will conduct a poll now again, just to ask that question of people. What is your preference to have as a financial buffer in the business? So is it equal to the worst loss you've had in the last 5 years? In this case, that'd be 300,000 available as a buffer to draw on. Is it double the worst loss? So in the case of the case study, 600,000, and on from there, 3 years buffer or 4 years or larger. So we'll give you a minute to fill that out, just to think about, ideally, or it might be the situation you have now, what you do have as a buffer, but also what you'd ideally like to have. So we'll use that as a way of starting to wind up our session today. So
just quickly, Matt, while we're waiting for the survey, I guess I did have a question about whether people have much choice in the value of valuing assets, and that's usually in terms of the banks placing valuation. And so, yeah, just make the comment that there's generally an approved list. Like each bank will have its approved list of a panel of valuers, and so you should have some discretion to select one from that panel. But generally, you don't have total free choice. If a valuer is not on the bank's panel of approved valuers, then the bank won't accept a valuation from them. So that's just a point to note, because we specifically got into that, I guess, on the water title issue.
Right. Thanks, Jane. So we'll close that poll in 5, 4, 3, 2, 1. Thanks, everyone, for taking part. We'll see what we've got there. So it looks like the majority, anyway, are in the double, having a buffer that's double their worst loss, and there's some that have preferred to have 3 or 4 times coverage, and we have 11% who have said they're happy to have a buffer equal to the worst loss. So, as I was saying, it does depend on individual circumstances, both financial circumstances and what the farm is in now, but also personal finances of personal preferences, of the owners of the business. So it looks like that, as I said, that the double the worst loss is the most popular coverage to have there.
I think that gives people relative peace of mind, Matt, without having to, potentially have too much buffer in reserve, so that they can do other things like reinvest in machinery and equipment and continue to grow their businesses as well.
Yeah, and leverage on the debt. Yep. Okay. So we will need to wind up now. So just as a way of finishing up, I'll just mention some calls to action to the audience. So I'd suggest that you check your own financial resilience measures, have a look at profit and costs and how your surplus is being generated, and in terms of a whole picture. But then also there's also sometimes often the need to drill further down into gross margin analysis and enterprise analysis. But check your own financial resilience measures. Look at the buffers that are available potentially in redrawing on debt and or your liquid assets, etc. And look at the coverage you have as a buffer in place relative to your worst loss. So there's some things that we can actually go away and do, and gives you something to look at, to analyse and think about. So there's further support available or information at Agriculture Victoria's website, agriculture.vic.gov.au dry seasons. There's other information available through the Rural Financial Counselling Service and other services that are out there. So I encourage you to look those up and to find out more. I'd like to thank Jane Foster for being with us today. Thank you, Jane, for the discussion and sharing your knowledge in the topic.
Oh, no, thanks for inviting me along today, Matt. It's been great discussion, and I'd also put out the offer that if there were any sort of follow-up questions or queries from the audience, and Mark has provided his contact details, I'm more than happy to answer any of those as best I can if they come through following the end of this webinar.
Thanks, Jane. And just to mention before I hand back to Mark, our next webinar in a fortnight's time in this series, we'll be looking at business impact analysis, assessing and prioritising the risks that we have in our business. And our guest will be Dan Duggan, who is an agribusiness consultant and risk specialist with ORM. And that webinar will be going to air at 1:30 on July the 2nd. So I'll hand back to Mark now to close off. Thank you, Mark.
Yeah, thanks, Matt. I'd just like to take this opportunity to thank Jane for being our special guest today. Just looking at the attendees for this, that's been pretty consistent for the whole hour, which is a fair reflection of the quality of today's webinar. So thanks again to Jane and Matt, much appreciated. As you can see on the screen there, the next webinar is in a fortnight's time. You'll get an invitation to that between now and then from AgVic and maybe also from ORM. So apologies to those who had issues with audio. If you're planning on attending the next webinar and you had issues today, I think the suggestion's been made to use Google Chrome or maybe even Mozilla Firefox, a recent version of those. And yeah, feel free to contact me on using those contact details that you saw at the start of today's webinar, in particular SMS and voicemail. I found them really effective last webinar. So yeah, thanks again for everybody's participation today, and hope to see you in a fortnight. Cheers, bye.
Bye.
Bye.